I'm Pavan. This is Akhil. So this is we're really excited to be here. We've learned a little bit about Ladies Who Lead. We've obviously heard about you guys by reputation as well, and we're excited to be able to share this condensed version of the class that we teach at Ashoka. Obviously, you can't condense an entire semester into an hour or so, but you guys also have a lot more business than the undergrads we normally. What we thought were some, interesting insights, frameworks, etc., on how to analyze businesses for an audience such as yourselves. So I think we'll take about an hour on the class time, and then that should give us plenty of time for questions, discussion afterwards. So when trying to analyze businesses, I think it's helpful to maybe take a step back and ask, why does a business exist? And businesses, if you look at the businesses around you, businesses interacted with existence, talk. Like what are the different reasons that a business might be started? Why would you start a business? Yeah, solving a problem could be one. Make money, most obvious one. Passion, yes. Yeah, that would again be a product vision, right? So yeah, those are, many different reasons. And if you look in any bucket, you will find examples of prominent businesses, right? So clearly Berkshire and Reliance were started and have been very successful in creating. The guy has a technology vision to fulfill that. There are people who start businesses to fulfill social visions, and obviously people talked about product visions, so Apple, Slip, these are started because someone really passionate about creating a product where they see a gap, whether it's kind of healthy snacks for kids or the right way for a personal computer. But although businesses can that the business should meet, right? The first is it must earn a remunerative return on invested capital. And that is kind of our the guiding metric that we look at when we evaluate businesses. So if there's one thing to take away from this class, when you think about a business, is focus on the ROIC, right? And we'll talk more about that later. A healthy business, which is a business that can earn a strong return on the capital that you put into the business, right, is either able to generate or attract external requirements, right? And that flourishing, thriving business and one that's able to grow. You will sometimes find businesses that have poor returns on capital that can still attract external capital, right? So Zomato, a lot of the tech companies you've seen in India. And so you might ask, okay, why is this business able to attract so much capital, get such an incredible valuation if it doesn't earn a return on capital? And the answer is, this is a business that can credibly convince its investors that it has a path to earning a higher return on capital in the future. So if you don't earn one now, you have at the very least to be able to show that you have a credible path to getting there, right? And you will find some businesses that have perpetually poor returns in capital. They have bad returns in capital now, and they're not likely to get any better. So if you take a small cement company, right? If you look at a company like Mangalam Cement, Priya Cement in the south, small subscale businesses, decently run, but if you actually look at the return they generate on the assets they have, they're low. They're cash positive businesses, so they can survive, but these are businesses that will not be able to grow, that will be basically see decreasing relevance over time, and it's only a matter of time before they fade away, right? So that's the ability to earn an appropriately remunerative ROIC is sort of the first condition. And the second is obviously that society has to be willing to permit you to conduct business on the terms that you need to for the business to sustain. You will find lots of exciting new businesses in areas like gaming coming up. The big question mark is, will the government say this is gambling? As you're seeing now in China, could you see the state come in and say, no, this is bad for people, we're not going to allow you to do it, no matter how attractive the returns are on the business, right? Video games, sort of same problem. Liquor, cigarettes, societies go back and forth across societies and across time in the same society, right? So the chief minister of a state could win an election and say, liquor is out, right? And then you could have an excellent business with a great product, great returns on capital, just gone because the government says liquor is bad for you. Cigarettes are highly regulated, just about everywhere. And then there are products that, some societies regulate, tightly, other societies don't regulate. Finally, you have things like competition laws that exist pretty much everywhere, right? So you have to be able to earn a decent return on capital, and what you do to earn that return on capital needs to be permissible by society, not just in the narrow sense where you need to be following the laws and, not doing something patently illegal. And when you run a business on a patently illegal basis, it most of the times blows up at some point. But you also need to be able to ask the second order question, which is society going to permit me to run this business and continue making this return on capital going forward? And things like gaming, video games, or if you think at the smaller level of individual entrepreneurs, owning a nightclub, owning a bar, running a school for profit, right? These are all things that they're not clearly illegal. They're not necessarily as cleanly legal as, an IT services company. They all fall into that gray zone, and you got to ask yourself, can I get away with it? You want to open a boutique in a Lal Dora area, right? The economics of that can be phenomenal because you have low rentals, you have fantastic footfalls, the margins really work, and you got to ask yourself, what's the risk that the commissioner of police shows up and says, I'm shutting this down, as periodically happens in places like Horse Cover. So that's the second filter you've got to put onto a business, right? Now, the truth is, if you look at most businesses, the business history over time, very few companies meet these conditions over an extended period of time, right? And why do they not meet them? Well, you get technological disruption, right? You get competition. So anytime you're doing something that has high returns on capital, that tends to attract competition. You've seen this happen in India in the last few years in card market, for example. Right? Finance were the pioneers of credit cards in India. So 7 or 8 years ago, these guys were making fantastic, margins, returns on equity, everything in credit cards. 5 years later, what's happened? 8 other banks and NBFCs have entered the credit card segments. People are competing to offer more and more attractive rewards packages. The competition is much more intense. And if you look through the last few conference calls that HDFCs actually slowed down their growth and seen their profitability compress because it's just a much more competitive space than it used to be. Can you guys think of other examples so how about we take some examples from you guys? Anyone have an example, say in each of these categories, right? Let's say technological disruption. Anyone have a good technological disruption example? Just got knocked out because of technology. Yeah, Nikon, all these were iconic brands, and they're just gone because of the smartphone. Thank you, Steve Jobs. Right? Competition. Anyone got more competition examples? You look at a business that was fantastic, and then suddenly somebody saw, or a lot of people saw the great economics that business enjoyed, and competition came thundering in. Who's got a good example? Right. But that's, so you're right, the Facebook wasn't the first social networking app, but those networking apps weren't actually phenomenal. So what I'm talking about is what are also known as honeypot results. So when you make kind of honeypot ROIC, what happens to honey? You put a pot of honey out there. If I put a pot of honey out on the balcony right now, what's going on? things. And honeypot returns on capital are basically, while this is so good, it's going to attract competition. So can you guys, it was a fantastic business. A bunch of other people saw it was a fantastic business. They entered, and it became an awful business, or a much less attractive business. Mm-hmm. Yeah, possibly, although I think in that case, it may have had a little bit to do with licensing also. Like Kelvinator is a pre-licensed Raj brand. And I think so that was less. I haven't looked at Kelvinator, at how well Kelvinator was doing before. I'm talking about a business, assume there's no government license issue. I'm just talking about a business that was fantastic, right? Were they earning really great money, or they weren't, right? So you guys need to think of something that was actually doing really well, making great returns on capital, making lots of cash, and the competition just came piling in. No, not Office so much. Office still. Okay, yeah, go for it. Okay. Yeah, fantastic. That's yeah. Hasn't happened yet, but I would absolutely bet. I suspect ethanol is exactly that today, right? The government, energy security, farmers, they're going to start procuring a ton of ethanol. Ethanol prices go up. Anyone with existing ethanol capacity is making amazing economics. What's happening? Every single person is standing in line at Praj Industries and Thermax and wherever they have to stand to put up an ethanol plant. You will see the economics of all these ethanol companies get destroyed in the next 2, 3, 4, 5 years, right? We can debate how much, we can debate what supply demand is, but there's no way they'll be making this much money. And by the way, no one was standing in line to put up an ethanol plant 5 years ago. It's only after the government came in and said, we will enforce the blending. The blending is going to happen. It's a reality of policy. We need it for energy security and UP. And people internalized that this was going to be the case in perpetuity. And they saw the incredible economics that the existing guys are making, that they all came running in, right? So that's a great example. Regulatory scrutiny. Is there a business you guys can think of that's just doing phenomenally well, but it gets killed because the government comes in and says, nah, this is too good to be true. I'm going to, yeah. Yeah, yeah, great example. Great example. And that's also an example we talked about in the previous slide, right? Government just decides, no, it is immoral for people to have children for other people for whatever reason, and so we're banning this, and there goes your business case, right? And then, although what I mean over here really is, actually, I'm making a slightly different point here where you're right, that's more relevant to the previous slide. Here, it's more that I'm not banning the business, but I'm wondering whether they were making too much money here, right? So, is a fair reason or an unfair reason? So to give, I mean, let me give this example actually. Take the Indian energy. Right? People go to where the liquidity is. Once you have the dominant exchange, say is the dominant exchange, and as India grows its traded power, which will happen as you move to renewables, IEX is in an excellent position. A couple of months ago, the government came in and said, no, IEX is going to be forced to share all its trades with any other exchange that comes up. We're going to enforce coupling, destroying IEX's monopoly. IEX is now running around trying very hard to lobby to get this overturned, and we'll see if it works. But that's the government coming in saying, yeah, this is a great business, and it's not in the public interest for it to be such a great business, so I'm going to just change the rules, right? That's another reason a great business dies. And then finally, there's obviously slower growth and diminished economic relevance as a product matures. You're in kind of cash cow mode, and if you don't return money to shareholders, you don't pull money out of a business. Many of you businesses or from families that run businesses know it's emotionally very difficult to say my business is going to die, let me not put more here, let me pull cash out and do something else. You end up forcing yourself to make suboptimal investments in projects, suboptimal investments in other areas, and so the company over time just diminishes in value due to bad capital allocation. So for many of these reasons, right, for, businesses don't stay in that ROIC plus society permitting them to survive for an extended period of time. Okay. Are we on time? We're
About 15 minutes.
okay. So we keep talking there's a very tiny amount of math over here, which is, I promise. What is ROIC, right? ROIC is just the return you get on the capital you invest in the business. If I'm any business today, it could be a hair salon, it could be a automotive components business. There's a certain amount of capital I'm going to need to put in, and there's a return that that business is going to give me on that capital. That's the basic metric with which you decide how good a business something is, and whether it's worth doing. What is ROIC? You can think of the denominator as what you put in, which is capital, right? And that's typically, this is fairly simplified, but it's typically some combination of physical assets and working capital. And what do you get out? You get out the cash flow that that business generates, adjusted for whatever depreciation. And then obviously strip out for tax returns, right? That's the basic ROIC formula, right? So to take an example, we just created this fictitious company, LWL Stationery, and this is actually this is a company that sells stationery products to people. Right? It does a revenue of 1.3 crores in its first year, 1.7 crores in its second year. So it's growing revenues nicely, as you can see. It has costs, obviously. It has, the cost includes material, paper, whatever you need to make the stationery, labor, right? The rental of the office or space that you're using. Selling and distribution costs to the extent that you're selling and distributing through partners, or just advertising, selling and distributing through partners, you'll be paying them some sort of commission, advertisement and sales, other kind of overheads, and so you get a margin at the end of that, right? So the first year, they make a 13% margin, so they're making 15 lakhs the first year, 21 lakhs the second year. Why is this margin going up over time? Anyone want to? Exactly. And can you tell us what operating leverage is? Reduces or reduces as a? Exactly. That's it. Exactly. Which of these do you think are fixed expenses, and which do you think, Exactly. And, depending on what horizon you're talking about, different things become fixed and variable, right? So rent may be fixed up to a certain point, and then if you want to scale beyond that point, you may need a little bit more. But by fixed, what we really mean is it doesn't scale linearly with production. So there'll be some level. The operating leverage may not be infinite, but there'll be some amount of operating leverage in there. So as you scale, margins actually increase over time. So you take this EBIT, which is the EBITDA, the cash profit that you make adjusted for the D&A expense, which we assume covers your maintenance, right? Put it into your denominator. You strip out the taxes. Into your numerator. You strip out the taxes. And then you divide it by the capital that's put into the business, right? So what is the capital? Well, they need inventory that they're holding. So that's stationery that you produced and haven't sold as yet. There's trade receivables, right? So stationery to somebody else. Right? Or your customer hasn't yet paid you for it. And then you've, there's kind of current operating liabilities, which is trade payables. So say you don't, you're buying dye or binding material or something from someone, and you say, no, I'll pay you a couple of weeks later, a month later, whatever it is. That's your payable, right? The net of your operating assets and your operating liabilities basically give you working capital, right? And then you've got the fixed assets, which is the machinery stuff that you have to put into the business. The sum of these two is your total capital, and 12% is business. Is more working capital a good thing or a bad thing? All else equal. Would you want to own a business that has high working capital or low working capital? How many people would want to own a business that has high working capital? How many would want to own a business that has low working capital? Okay, you should all want to own a business that has very low working capital, because basically this is what you're getting. This is what you're putting in. The more I can lower your working capital, right, the less I need to put in to get the same thing. If I can get this 13 lakhs by putting in less, I have a better business. Right now, I have to put in 105% every year, right? If I could cut my working capital in half, let's say from 84 I made it 40, right? Then I only need to put in 16 to get 60 to get 13, and I'd have a 20% ROIC business, right? So I have to put in less money to get more. That's a good thing, right? If I can find a new technology that lets me produce with less fixed assets, or I can do something to improve my working capital and reduce it, that's much better for my business. Can you guys think of ways in which one might, fixed assets is clear. I mean, you could invent a new way to produce, you could buy better machine, you could figure out some way to optimize your fixed assets, although that's hard in the short term because technology, production functions are kind of fixed. What could someone do to improve their working capital? Yeah. That's your margin. Your labor cost, reducing your labor costs will help you here, right? They won't help you with working capital, right? It'll expand your numerator. Working capital will shrink. How would you, yeah. Exactly. So a stronger business, now that's also less easy to do than it sounds, because your payable and your receivable days are a function of your bargaining power. So if anyone here is familiar with the auto components industry, Bajaj is a great example of a business that operates with negative working capital. Why is that? Because when the Bajaj dealer shows up to take motorcycles from the Bajaj factory, he pays Bajaj right there, right? Bajaj will pay all the component folks 1 month, 2 months, 3 months late. So Bajaj has this beautiful business where he makes a product, gets paid for it immediately, and a huge portion of what it costs him to make the product, he doesn't pay till later. He actually has negative working capital. The most powerful businesses, these are typically businesses with really strong brands, really entrenched business positions, are actually able to do this. Because Bajaj can say to the dealer, look, it's a Bajaj bike, of course it's going to sell. You've got the easiest job in the world. People will come to buy Bajaj bikes every month because that's just what they do, and you're the only dealer in this town, right? And he'll say to the components guy, look, you know that I have 35% or whatever of the Indian motorcycle market. This stuff is going to sell no matter what. You've got a really easy job. You make some plastic molded thing and give it to me. I'm going to pay you 3 months, and just factor that in whatever you do. Business lena hai to low, otherwise I have 2 other guys who will do it just as well for me. That's a company with very high bargaining power, so they can get negative returns and they can get negative working capital. Most businesses are not in a position to do that, but if you can, it's great. Okay, so this is actually the video here. Does this?
Sir, may I present to you the super luxury yacht, the Nefertiti. Apart from all the luxuries, it has 6 luxury suites, 3 kitchens, a mini golf course, a 3D theater, 2 ballrooms, and to top it all, it has a top speed of 25 knots.
कितना देती है?
For a country obsessed with mileage, Maruti Suzuki makes India's most fuel-efficient cars.
Right. So obviously that, I don't know if you're old enough to remember it, but was a very famous ad 20 years ago. But I put it into this because that's basically what I want you guys to do when you look at a business. It could be any business, family's business, a business you're working at. It could be ethanol, it could be chemicals, it could be, Maruti Suzuki, right? You should be thinking when you look at a business is, kitna ROIC? And we talked about what the reasons were for ROIC. Is it because brand like, but is it because you have fantastic technology? Regulatory barrier to entry, like the, or maybe like Kelvinator pre-liberalization? Is it because you have scale, like an exchange, right? So, कितना ROIC देती है, क्यों देती है, देते रहेगी, right? This is just to give you an illustration. When ROIC, we're using ROE, which is a related number, but we don't need to get into the details of that here. It's easier to screen for across, when you're running with data sets. See the range that you get, right? Automobiles and components, these are kind of moderate ROIC businesses. They're moderate because they tend to be capital intensive. Hundreds of millions of dollars invested. So, you need to keep earning money to sell the same number of money. So it's a the ROIC is challenged. Banks, again, because they're utility type industries, low ROIC. What are high ROICs? IT services is a high ROIC business. Why? They don't take a lot of capital. You put people in a room like this, you pay US way, it's a beautiful business, right? High ROIC. Consumer goods companies tend to have, so the consumer staples, again, you'll see net who takes the contract, you shop, well, no, okay, so yeah, ROIC is post-tax, okay, let's say an FD gives you 6% post-tax, right? Right? Cost of capital hurdle rates are a good way to think about ROIC, but the basic question you want to ask yourself is, what else could I do with my money, right? And that's why FD analogy is a good one. You could do FDs, you could put in a mutual fund. The other thing you've got to figure out when you look at alternatives is, what's the brain damage? So clearly putting it in a mutual fund is costless, so you don't need to get out of bed. Your money will just compound for you at a certain pace. And then there's a matter of risk, right? So if most mutual funds to give you, I don't know, 10, 11, 12% over time, would you do a business at 13%, at 14%? You might say, no, you know what? I want a little bit more of a premium on that, because a business takes a lot more of my time, a lot more of my energy, and has more risk. I'm in a single business as opposed to a diversified set of businesses. So I probably want it to be, I don't know, 14, 15, 16, 20%. So there's no right answer here, but you need to think about the opportunity cost of capital principally when you start a business. And if you're going to be the entrepreneur yourself, right? So if you're starting it and running it, it's the opportunity cost of your time and the stress as well. But assume for a minute, you're just thinking about passively whether to allocate capital to a business or not. The real question is, what is the opportunity cost of your capital? And yeah, most people would not start businesses that gave them less than 14, 15% returns on capital. Okay, what ROICs do you think the following businesses would make? So let's take a lemonade stand or a chai ki dukaan. What do you think the ROIC would be for some? It'd probably be in. And we know this because we know if you look at the companies that lend, to your point, the cost of debt, right? We know that the microfinance companies that lend to these guys are lending to them at 20, 25, some cases 30% of it's a money lender to start these businesses, right? So the premium they would need over that to be, for the equity would be significantly higher. So a chai ki dukaan probably would be 40, 50%. So we're using this because of Ashoka, but let's say it doesn't have to be Ashoka, it could be any large company. A taxi service serving Ashoka University or a big company, think Lever, Bharti, contracted to provide all taxi operations to this big entity. Indigo, great example. What ROIC do you think that business would? Yeah, that would be my guess. I mean, Aditya probably did exactly this analysis or does it now at Akasa, right? When they sit across the table and say, right, you're doing my car contract, how much can I squeeze you? And the calculation he's doing is what ROIC would I need you to do this business for me in a halfway capable manner, but still, keep the juice on my side of the table. And my guess is you'd arrive at somewhere in the 13, 14, 15% range, right? What about a taxi service supplying cars to Uber? Let's say I started a business where I wanted to hire a bunch of drivers, to run them, and I just put them all on Uber. What ROIC would that earn? Higher or lower than serving Ashoka or Indigo? Lower? So if you'd work for Akasa at 14%, you'd work for Uber at what? 10? It should be higher. What's riskier? Having a guaranteed contract for an airline or owning 100 taxis out of 20,000 that Uber is using? It should be higher because it's much riskier, right? Taxi service serving retail customers in Sonipat would be low? If you had 10 taxis in Sonipat or Murthal or somewhere, what ROIC would you guys want? If I pitched you a 10 taxi stand in Murthal, Sonipat, Faridabad, take your pick.
I think the question you're asking is what would I want?
Yeah,
That's the question.
If you were to go in and start this.
If you had a choice between, putting these taxis at Indigo or Tata, you had a choice of giving it to Uber, or you had a choice of sending it to Murthal or Sonipat. Depending on the risk, where would you want the higher return? So now try to think about that question that talk.
So you guys said 14 for Akasa and say a little bit higher for Uber, because it's just what would it give you?
Yeah,
Exactly.
because the idea is that higher the risk, you want the reward to be that much higher, right? On the other side, like Pavan was saying, the mutual fund example, mutual funds can go nuts.
Index fund, Karu.
By and large, it's like, it's safe. Like it's a post office, right? Your national savings scheme in the postal, this thing, it's very low reward, because the risk is also very low.
Okay, steel plant. Yeah, not that high, right? Because as long as you know how to make the steel, someone will buy it. There's some sort of cyclical risk, etc. But pretty much if you start a steel plant, the steel gets sold. People don't underwrite. Consulting firm. Yeah, pretty high, right? Because there's no real, I mean, it's all in the people, there's no real moat necessarily. They don't require a lot of capital, but the return they learn on that capital will be high. And finally, software, I think we talked about this, it would end up being high, right? And that, I think, summarizes low ROIC businesses are typically capital intensive or regulated, so the government is giving you a guaranteed return on a power plant, you don't need a high return. They tend to be low risk businesses, like having the taxi contract for Akasa, or businesses that just have low bargaining power with customers and suppliers. High ROICs are capital light, businesses that rely on an intangible form of capital that are not captured in the brand. So an ad agency would be like that. If like the Whedon Kennedy guys who actually did the branding, I think, for Indigo, those guys went off and started their own agency, right? Now, the return on capital there would be high, but if you actually look at it, what is the capital they have? It's their brain power, it's their creative ability, it's all of that which isn't captured in the numbers. And that's important to keep in mind. Obviously, businesses with high bargaining power. Over time, what happens to high ROICs, in line with what we said, they kind of decay. And that is what Mr. Warren Buffett repeatedly reminds his shareholders of.
Great, thanks. So just building, I guess, on, I think what I'm going to do is essentially build on what Pavan's already talked about, which is just ROIC, maybe looking at it a little differently in terms of good businesses, mediocre businesses, what they look like, what are some of the attributes, and then use a couple of examples and share some data. So maybe just to kind of get the conversation going a little bit, what is the best business you've ever come across? I only have 2 rules. Company has to have existed for at least 15 years, and it can't be what my generation calls an internet business, which is anything too new agey. That hasn't proven, it probably won't be 15 years old. What's the best, and none of Facebook, Amazon, Apple, none of those. What's the best business you've ever come across? Okay, alcohol. Okay, yeah, maybe name a company, specific company. Okay, Procter & Gamble, lots of consumer companies. Sorry? Okay, any other industry outside, a company from a non-consumer company? Okay, so like a niche business in chemicals or something like that? Okay. Yeah. Okay. Okay. Okay, we'll come back to this in a second. Here's question 2. So, Mr. Buffett has this categorization of businesses as good, great, and gruesome, right? So good, bad, ugly, basically, sort of, or good, average, and really bad. For some of these companies, some obviously household names, you've heard of them, some you haven't. What would you guess if you had to, let's say you offered to own one of these businesses 25 years back, and this is yours, which one would you pick? I guess we're looking for the good or the great ones here. So Starbucks, how many people would pick Starbucks as a business to own for the last 25 years, last 30 years? Okay, how about, what else? Sony, okay. Colgate, any others? No one wants to own Mercedes? Rolls-Royce? Okay. Any takers for Whirlpool? No? No, these are all still publicly listed. Every single one of these is a publicly listed. I picked this for a reason. These are all listed companies. They're still listed today. All of them. Okay, anyway, here is, and part of the reason I picked this is the outcome if you bought these companies 35 years ago. Start date is the same for all of them, 1986, the end of December 31st, 1986. If you own them for 35 years, here's how you would have done. And I've used this as a proxy for owning the business effectively, is being a partial owner of the business by buying, one share. Starbucks tops the list. You would have made 336 times your money. Followed by Middleby, which is a manufacturer of restaurant equipment. The ovens and the stuff that goes into a Subway or a McDonald's or something else. Number 3 on the list is Shimano, which makes bike gears, a Japanese company. And then the household names are all much further down. And basically, if you've made sort of 30 times your money in 35 years, which is Colgate, or 33 times, you haven't done so well. On a compounded basis, you've probably made a single-digit return. It's as good as keeping your money in an FD in India. Maybe in the US, it's still decent return, but by Indian standards, not a great return, right? What we look for. So I think point being that there are often non-intuitive outcomes to what we think a good business is, right? So that's what I want to spend a few minutes on, is what attributes do you think good businesses share? So coming back to some of the companies you mentioned as best businesses you've ever seen, what are some of the attributes when you just think about why you like that business so much? What are the attributes that they share? Okay, so meaning they will just keep delivering good results? That's... Okay, so maybe touch on scalability. What do you mean by scalability? So maybe it can address a large market. Okay, all right. Long runway for growth, something like that. Okay, what else? Okay, should be constantly innovating so that they remain competitive. Okay. Okay. Okay, high degree of customer satisfaction. How does that manifest in, what does that do for the company? If you pick a people keep coming back. Okay, so it goes back to consistency, right? So you'll get some degree of, let's call it durability, right? Effectively, it'll be around for a long time. You'll just keep, it'll be a more durable business. Okay, what else? Yeah, okay, so making it hard for others to come and compete with you. Again, kind of durability, somewhat like that. Anything else? Accessibility, so well, can you expand on that? What do you mean by that? Okay, so again, address a large market. Okay, sorry, someone had said something else before. Okay, so high market share. Okay, so we want a large market, we want high market share, we want consistency in numbers and in performance, loyal customers, high barriers to entry. Anything else? Great team. Okay, that's always good to have, better than not having a good team. What else? Anything else? How so? So. Okay, so I think someone mentioned that before as well. Be innovative so that you can change with the times. Okay. Okay, so I put down a few. I think you all have mentioned many of these, right? So ideally limited or no competition. Why settle for any competition? Let's have no competition if we could. Pricing power, which no one mentioned, but ideally we'd like a business that has the ability to price up when times get tough, or when its competitors can't. Maybe it's the first one to price up. We talked about ROIC. That's the same as ROE, return on capital, already. Recurring or predictable revenue. So again, in terms of consistency, one way to get consistency is just have a recurring revenue business. Part of the reason people like software companies so much. You signed a license, for Microsoft Office, you're probably going to keep it for your professional life, through your professional life. Loyal, happy customers. We talked about that. Consistent cash flow, positive cash flow. Again, someone mentioned that. Runway to grow, large addressable market, so future looks bright for growth. Capital allocation, we didn't touch on that, but being able to, if you do generate cash, being able to deploy that capital intelligently. And then all things being equal, you'd love to have rational competitors so that you don't have, which is a problem for many of the new age companies today, is if you've got irrational competition, you might actually have a decent business, but you may not be a good business for many, many years as a result. So broadly, we end up bucketing these things into what I call the trifecta, which is unit economics, durability, and reinvestment potential, right? It's a three-legged stool. If you can have all three legs, you're on firm footing with this. And we'll touch on each of these briefly. So maybe just picking the first, which is unit economics. So unit economics essentially very closely linked to ROIC, what Pavan already talked about, which is it's just a different way of looking at ROIC, which is embedded, generally speaking, for many businesses. If you're generating a high ROIC, embedded in there are good unit economics, right? I mean, so if I am a really good retailer, let's say, or if I'm Starbucks, someone mentioned Starbucks. Starbucks provided the best returns, out of all those companies. If you boil Starbucks down to a store level, the unit economics should be good at the store level, right? Generally speaking, all high ROIC businesses tend to have unit economics, some easily demonstrable, some not. So that's unit economics. Durability we'll come back to, and then the reinvestment rate, which is the third leg of the stool that I had here, reinvestment potential, right? Is just, you generate all this cash, if you're a good business, are you able to deploy that cash back, right? There are lots of examples of businesses that are great, but they can't redeploy the cash that they generate, right? So maybe let's touch on a few examples there. What are examples that you can think of maybe you've got a really good business, but you know, that throws off lots of cash every year, but you can't put it back into the business. What might be an example? Yeah, tobacco is a great one, right? I mean, ITC has had to go and, you know, start an FMCG business because they couldn't deploy the cash back into tobacco. They've had to destroy some capital putting it in hotels because they couldn't start, you know. What else? Anything else come to mind in terms of businesses where it's just gushing out cash? If you can't put the cash back into your own business, right, you've essentially got a capital allocation problem. We'll come to that a little bit later, but basically what you'd like is, I created one box, and now I want to go and create 20,000 of these boxes, right, which is Starbucks, essentially. If you rewind back, you know, 30, 40, 50 years, that's what you'd like. So the businesses that can't do that, where you've got a great business, it's throwing off lots of cash. A lot of small businesses have this challenge, right, where you might have a great business. We touched on high ROIC businesses like an ad agency or something like that. There may be limits to how much you can grow. A niche business in chemicals, which someone mentioned, again, there may be limits to how much more capital you can, you know, the market can only absorb so much of your product. So you can't keep putting up. Exactly. Yep. Yeah, yeah. Let's say you're an exchange, right? You've created a platform one time. You're the National Stock Exchange. You've created a platform one time. Where do you deploy all your free cash, right? There's no place to put it. Or you're Microsoft. You've created Windows. Yes, some of it goes in upkeep R&D to come out with the next version of Windows or Microsoft Office. But beyond a certain point, you need to start a video gaming line. You need to go start, you know, a cloud business, et cetera, to redeploy all that cash. Microsoft has no debt, right? So all that cash is going to new businesses. So that's essentially the reinvestment rate, which is the amount of cash that you take every year divided by the same denominator as the ROIC formula. NOPAT is the same as, it's just non-operating profit after tax, which is the same numerator as the ROIC formula. So it's how much you invest each year divided by that. So in an ideal world, if you could put all of it to work, this number would be 100%. All the cash that comes out, I deploy back into the business. That's a 100% reinvestment rate. If I put half back, that's a 50% reinvestment rate, and so on, right? And one outcome of that that's just sort of mathematical but helpful to know is your ROIC multiplied by your reinvestment rate is essentially what your business will grow profits at. So one multiplied by the other gives you profit growth, basically, for the business. If you wanted to think about how your profits will grow, it's just the multiplication of those two things. Here's some comments on the three criteria that I talked about earlier, right? So, and these are all from Berkshire Hathaway. We are big fans of Mr. Buffett in our class, so a lot of this is materials all from our class at Ashoka. So the first is just on unit economics. Always look for a business that does well in terms of ROIC, right? Which we talked about. Unit economics, ROIC, very closely linked. The second's on essentially durability. Business that's a great business means that the business is going to have a high return on capital for a very long period of time, right? That's sort of durability. I'd like this to continue for forever, ideally. And then the third is the ideal business is one that earns very high ROIC and keeps using lots of cash at those high returns. That's your reinvestment rate. Right? It's kind of the, if you just had to take, you know, ROIC and this trifecta away from this class, I think that's, you know, plenty in terms of what constitutes essentially a good business in most cases. So let's just jump into a few of these attributes in a little more depth, just with some examples from the real world. So this is Starbucks. Starbucks has amongst the best, probably the best, used to be, you know, as of like a few years ago, the best unit economics in the restaurant business or the QSR business in the world. You know, when compared, and you know, these are the other ones that were good, and Starbucks was even better, right? So This is just measuring Starbucks's return on capital. So the way you calculate it at a store level, again, when you're running this kind of business is, how much capital does it cost me to build the store, right? What is the average sales or average unit volume that I do from that unit, that store? So just to pick the example of Starbucks in the US, $680,000 to build a store, $1.5 million of revenue from that store. EBITDA just is profit, effectively, or cash flow. Think of it as a proxy for cash flow. It has a 30% profit margin or operating margin, which means $450,000 comes out, right? So we put $680,000 in, and we get $450,000 out, right? You can do the math on what that is. You measure two things. One is the payback period. How long does it take for me to get my $680,000 back, which is about a year and a half? And then what is my return on capital, which is 66%, right? The ROIC. So that, again, we'd agree is a terrific business or a very high ROIC. This is the same thing from Starbucks themselves, talking about how much they spend, and they've just looked at it differently. Sales, so revenue divided by the investment that they make, is roughly at 2 times. So people often call that an asset turnover, right? Or investment turnover, which is how much should I put in and what's my revenue. And then profit margin, what's my cash profit margin, right? 25%. And when I multiply those two, I get ROIC. So if I have a 25% profit, so if I put in 100, my sales are 200 because my sales to investment is twice what I put in. And on the on the 200, if I make a 25% margin, that's 50 of profit on my 100 of investment. So I make a 50% return, right? Please stop me anywhere if you'd like or you have a question. There's a number of slides and I want to try and get through them and then we can sort of get into Q&A. This is India, so bringing the example to India. This is again a comparison of QSR. Retail businesses are very good to think through and understand ROIC because you can think of it in terms of one store, right? It's easier than most other businesses. Some businesses aren't as easy to boil down to one unit. So, ROIC becomes a little tricky. So I tried to pick examples where it's just easy to think through. So this is for India. These are, again, listed companies: Domino's, Sapphire Foods, Westlife, which is the McDonald's franchisee for the West and the South, and Burger King, India. And Domino's has been around the longest, and therefore partly has higher ROICs, but also because of the nature of the business, has higher ROICs than the others, right? And so Domino's is a 46% ROIC versus KFC at 27, and then the others are still just about beginning to look attractive. Here's another example. This is a hospital business. This is Max Hospitals here in Delhi. So this is how you think of ROIC in the context of a hospital, right? Rather than doing it at a hospital level here, you do it at a bed level, typically in the hospital industry, right? So you try and find the unit that you can boil the business down to, where typically capital goes in, right? In the hospital business, people think of capex per bed, which is about 1.3 crore. Then you look at ARPOB as average revenue per operating bed. So you figure out what that is, and then it's the same again. It's basically how much revenue does that unit make, how much profit does that make, and then I calculate ROIC. Okay, the second aspect is durability, which is what we discussed earlier, is just the longevity, right? Like we said, we want consistency, we want longevity, which if we have high barriers to entry, will typically work. One of the things, there's the obvious, which I haven't touched on, which is for most businesses, I think like Pavan asked you for examples of businesses where if the honeypot is too good, competition is a given. Unless you have, you own a cornered resource of some kind. You own a mine that no one else has, right? You own the world's largest copper mine or something like that. You've obviously got a resource no one else can replicate. But other than that, and a few other examples, you have a regulatory license to do something, right? You are, what's the company that does all the railway bookings and transport? IRCTC, yeah. So if you're that business, you're basically a monopoly, right? In a sense, you've been granted a monopoly license effectively. Oh, an airport, yeah. If you're the only, yeah. So, yeah. Yeah, although there you haven't really, unless you're at the bleeding edge, maybe if you're TSMC and you're the only one that knows how to make a 3 nanometer chip or something like that. But otherwise, there are From time to time, you will get competition. I mean, you know, basically, if you have no competition, effectively, or can't have competition, then you've certainly got durability. But that's, again, those are edge cases. For the most part, most of business faces competition all day long, right? People figure out where money's being made, and you know, they rush to go start businesses in that area, whatever they might be, right? So you'd like to find businesses with moats, but the reality is durability, you have to look beyond just the obvious barriers to entry for what could make a business durable, right? And in certain examples, I think what people have found that's worked really well over long periods of time, and I've picked examples of just companies that we'll talk about a little more, so sticking with Starbucks, is it really boils down to people. I mean, at some level, Starbucks is a people business, right? Because there's baristas in the store who make your coffee. They determine the experience you will have, right? Anyone can make the cup of coffee, in theory. Anyone can go buy the beans and make you the same cup of coffee. But there's a reason people keep coming back to Starbucks. It may be convenience of where the stores are located, but it's also the experience that they have in the store. It's the skill and the consistency with which that person gives you that cup so that you know what to expect and you keep coming back for more, right? And the same might go for an airline as well, right? Where you may keep coming back. It's largely a people experience. Anyone can get you from A to B maybe, potentially, right? So one big piece here is people. And another way to put it, this is from Amazon's 2020 shareholder letter, is customers. Basically, businesses that are ruthlessly customer-oriented, essentially, and come up with a win-win equation, tend to be ones that are more durable. All things being equal, if you can service your customer really well and make sure that it's a win-win for yourself and the customer, you generally have, you know, at least a shot at being a durable business over a long period of time. So that's the one attribute of durability that I've sort of picked on here. There are obviously many others. I want to spend a few minutes now just on Costco. How many people here are familiar with Costco? Okay, so quite a few. So essentially, Costco is maybe what, has anyone here been to one? Yeah, so maybe just describe it for everyone else, please. Yeah, effectively, so they don't even call the stores, they call them warehouses, right? Because you're basically going to something that's as large as a warehouse to shop for household goods, largely. But it's not just household goods. The business actually sells everything from it's actually, I think it's the largest, or maybe the second largest jewelry retailer in the US. You can buy a diamond ring there if you're getting engaged. It sells fine wine. It also sells probably the cheapest ketchup and, you know, flour and everything, cheese and everything else that you need for your fridge. Sorry? Yes, it's a membership model, exactly. So you have to pay to, it's nominal, it's about $60 a year for, and get what are considered to be, and most people who walk in that door believe are the lowest prices you can find for that particular item anywhere, right? So that's basically why. And so we've all heard of Walmart, I'm sure, and some of these other retailers that I've listed out here, Macy's, Target, CVS, Walgreens, etc., right? But there's a reason why Costco has beaten the pants off everyone else, right? And we'll get into that a little bit. So typical retail business model, everyone's familiar with. It's basically a box through which goods travel, right? This is one way to think about it. Stuff is coming in there for people to come and pick up and purchase, essentially, and take out. And what you want to try and do is move things through that box as quickly as you can, right? Because the box makes money the moment a good leaves the box, right? If I think of the store as a box, the moment a good leaves the box, they've made some money, hopefully. Whatever it may be, whatever the margin on that product may be, they've made something. So your objective is to try and get stuff through that box as quickly as you possibly can, right? Which is basically what a retailer does. So what is Costco's revenue model? Costco, like someone mentioned, is a membership business. People pay, some of this information is a little dated, it's a couple of years old, but it still stands, which is people pay on average $60, $70 to be members of Costco, which allows them to go and shop there. And essentially, it costs them nothing incrementally to provide that membership, right? Anyone can go become a member at any point in time. So the membership fees they collect are extremely lucrative. Essentially, it comes for free, right, with everything else that they provide incrementally. So today that number is about 4.4 billion. They have roughly about 60 million members and collect about $4 billion a year in just membership fees alone, right? And I think what Costco has done, and which we'll get into in a second, and it's really the reason I picked Costco is to touch on one example of strategy in business or a model in business that's worked particularly well as far as building durable businesses is concerned, is essentially this virtuous cycle of giving back to the customer. So going back to what we said earlier about durable businesses treating their customers, being customer-centric, is basically selling things at low prices, which gets people in the store. It gets them want to buy a membership because they know they'll get it cheaper there than anywhere else. Because they're able to do that, it takes their sales up. Because their sales go up, they're able to get more leverage with their suppliers to be able to buy goods at cheaper prices, right? So in essence, if you run retail well, that's how a model should work, broadly, right? Is you keep trying to get better terms from your suppliers so that what you put on your shelf is cheaper than what your neighboring store puts it at on their shelf, right? And the quote from Costco is important because it really touches on the way their philosophy around business, which is that many retailers look at an item and say, I'm selling it for $10, how can I sell it for 11? They look at it and say, how can we sell it for 9? And then how can we get it for 8? Because if they've sold it for 9, the customer's coming back again and again, right? So they're not trying to gouge the customer. If anything, they're trying to get it cheaper and pass those benefits on to the customer, right? A couple of other things to touch on that are important here, right? In a retail business, what you want to do if you want to try and push as many items through that box as possible, right? In terms of the business itself, is don't keep too much variety, essentially. So number of SKUs, stock keeping units, right? Which is distinctive items in the store. Costco has 4,000, or Walmart has 120,000, right? So the one thing you will find when you go to a Costco is if you're buying ketchup, there will only be one brand. There won't be, if you go to a regular supermarket, there might be 3. And the same goes for anything else, right? Pretty much every product, there will be one item of it. But the thing you do know is it will be the cheapest ketchup you can buy anywhere or anything else, right? Again, to demonstrate with numbers, Amazon may sell you a 32-ounce ketchup for $3.38. Costco will sell you 132 ounces. The other thing Costco does is they bundle. So you can't buy just one. It'll be a pack of 3, typically, or a pack of 6, or something like that. And what does that do? It takes the price of that item up, meaning the price of the ticket, what the customer pays, up. As opposed to paying $3, they're paying $8 for that, right? The price per ounce is good for the customer because the customer's paid 6 cents an ounce because they bought a lot more ketchup versus 11 cents an ounce if they bought it on Amazon. But what they've done is paid $8 to the retailer. And if you believe the retailer is going to earn a margin on the GMV, right, the total retail value of stuff sold, then you want to try and maximize that, right? So that's what they're trying to do by packing things into larger order sizes or purchase sizes, essentially. Right? Those are the two sort of key ones. Sorry. Yeah, so I'll just touch on this for a second. I think Pavan did already, which is ROIC, if we just had to break down one level further, right? It's operating profit or EBIT divided by invested capital. All we've done here is add revenue to both sides of the equation, right? And, there's a reason for that, which is now you can think of ROIC as, if you take the first element of that, which is EBIT divided by revenue, that's your operating margin, right? And if you take the second element of that, it's revenues divided by invested capital, which is your capital turnover, right? What we talked about earlier in the example of Starbucks being 2 times, for instance, right? So that's this, how much capital did I put in? What's the revenue I get out of it? And so now I can multiply those two, just like we did for Starbucks, to figure out what ROIC is. And the reason I bring that up is we can now think of Costco along those lines, right? What is the profitability of the business, and what is the capital turnover in the business, right? So this is just same-store sales growth, which over a long period of time, this is like 25 years, 30 years, is just showing you that it's been higher than Walmart and Macy's. I just picked 2 others to just make the point that they've grown much faster than the rest, partly because of the model that they have. The thing that's more impressive is their inventory turnover when compared to the other 2, right? So a Macy's will turn its inventory 3 times a year, the entire stock in the store 3 times a year. A Walmart will do it 8 times, and Costco will do it 12 times, right? So once a month. So that in a retail business makes it, or in any business, frankly, makes a tremendous difference. This is another way, we look at ROIC for investors or practitioners, which is basically trying to decompose it, just like we did right now, into operating margin and capital turnover. You can keep going further back and figuring out what are other elements that go into those inputs to figure out where the source of competitive advantage for that business might be, right? So, for instance, in the case of Costco, this is Costco versus its peer group. Costco has more negative working capital than its peer group. It's not uncommon in retail to have negative working capital. Costco has more negative working capital than its peer group. But it has lower margins than its peer group. It's only 3% margins versus 5% margins for its peers, right? But the capital turnover, what we talked about, revenue divided by capital that went in, is significantly higher. It's 8 times for Costco versus 3 times for its peers, right? So you can begin to sort of look back, peel the onion a little bit, and try and figure out why is this business, right, producing better return on capital? Where's that coming from, essentially? That's the idea with decomposing it. So this is a quote from Jim Senegal, who's the founder of Costco, basically saying that we've established what has been referred to as absolute pricing authority, right? That's how they think about it, which is basically when we set a price for something, you know that you will not find a lower price anywhere else. And of course, they have a policy saying if you do, you can bring it back in and we'll give you your money back and all that. But the idea is they want zero doubt in the consumer's mind, right? That's how you build loyalty, that's how you get the repeats, that's how you get the memberships. That you can never find this anywhere else, right? That's an intangible that they've built over many, many years in the business, right? There's an example of them not selling sugar in their store for a while in Portland, Oregon, because their peers in the supermarket industry were discounting sugar for some reason. This is a long time back. I think this was in the 70s or 80s. And they refused to sell it. They didn't sell it simply because they did not want customers to walk in and realize that sugar could be bought cheaper somewhere else. So they want a customer to believe, when you come into the store, I will not find anything cheaper anywhere else. This item cheaper anywhere else, essentially. Here we go, okay. The other thing to touch on durability, like we did with Starbucks, is people. Again, it's a retail business, it's a box, but really what matters the most is there are people, that serve the customer, that create the retail experience. So key element within durability is, and if you look at their largest expense outside of the markup that they charge on the goods they sell, it's employee cost, right? The single largest expense item for the business. So solving for that, making sure this is an industry typically that has high turnover, right? High attrition. People, for a lot of people, their dream job is not to work in a store their entire life, but they create an environment, they've offered benefits that make it attractive for people to stay in that job for a long period of time. Starbucks has done something very similar, offering health insurance, benefits, et cetera, all of that, right? So just retention matters, lowest costs, creates a better customer experience. And then this is just the durability and reinvestment part, right? So basically stores have continued to grow. They had a great model where, touching on the third leg of that stool, you can reinvest back into the business because you can open more and more of these stores. And as a result of that, you attract more and more members, so the virtuous cycle kind of plays out. So membership fees have continued to rise as a result of that. And margins have stayed more or less the same. They haven't moved all that much over time. Just they moved up, inched up slightly, and so return on capital has gotten slightly better over time. This is kind of a 20-year snapshot. So again, just making the same point that revenues have grown. It's now the third largest retailer in the world, $220 billion in revenue. And now has 850 stores. Used to have 350 20 years ago, 370. So store count's only doubled, or slightly more than doubled in the last 20 years. But it's created a tremendous amount of value. Market cap's gone up about 16 times, from 15 billion to 240 billion dollars. So this is the point I want to touch on, which is that, are we okay on time? I think we're pretty much. Okay. Models for thinking about competitive advantage in businesses, right? And durability in businesses. One is this thing called scale economies or scale efficiencies shared, right? Which Costco is a fantastic example of. Amazon's a really good example of it, and there are many others like it. The durability of the business, because you'll build customer loyalty, right, which will bring customers back, which allows you to then continue to do the same thing over and over again, right? Which is, as I build more stores and get more scale, I'm able to buy the same item even cheaper. And I can then price that item even lower to the customer, which then delights even more people and gets me even more members and allows me to set up even more stores, right? And then it feeds on itself. And that's kind of what I have down here in the corner, which is, this is Jeff Bezos's famous flywheel that he put on a napkin, 25, 30 years ago, which is essentially the same thing, right, that Amazon tried to do, which is, as you build scale, the one thing most of us agree on is if you go on Amazon, you're likely to probably find the lowest price for something that you're looking for. It's rare that you find it. You do sometimes find it outside of Amazon, but for the most part, you'll find it on Amazon. It's the same construct, which is, I'll make the price so low, and the reason I'm able to do that is I have the leverage with my suppliers to essentially drive down prices, either because of the customers that I'm bringing and the scale that I'm bringing to the business, or in Amazon's case, they started allowing third-party sellers to sell on their platform. They basically said, let's have sellers compete to sell on our platform, right? So various ways to do it, but the idea being that you share the benefits with the customer. What it also does is it makes life very difficult for your competitors, right? So to pick another example that I'm sure Aditya can spend some time on as well is the airline business, right? I mean, if you take Indigo, right, I think as an outsider, what Indigo did really well was build scale, drive down operating cost, right, in the business, and pass that on to customers. The fares were always very competitive, right? And as a result of that, you just build more and more loyalty, you gain market share. It's a virtuous cycle that keeps paying, right? So many examples of this. It doesn't have to be in the form of low prices. Yep,